Hello everyone, welcome to our Advanced Moving Average webinar, Tuesday, 26th of July. We're nearly in the end of July. So yeah, a more advanced webinar this time. Just some different moving average, more advanced one, more complex ones, which we're gonna see in a minute. So before we do that, I need to go through the disclaimer as usual. If you're facing any audio or visual issues, please let me know. Also, I have uploaded the handout in the slides in the handout section, so feel free to download it. And this is recorded as usual, so yeah, it's recorded as usual, so don't worry if you cannot attend in the full length of the webinar. So this material is provided as general marketing communication for information purposes only and does not constitute an independent investment research. Nothing in this communication contains or should be considered as containing an investment advice or an investment recommendation or a solicitation for the purpose of buying or selling of any financial instrument. All information provided is gathered from reputable sources, and any information containing an indication of past performance is not a guarantee or reliable indicator of future performance. Users acknowledge that any leverage in any investment in leverage products is characterized by a certain degree of uncertainty, and that any investment of this nature involves a high level of risk for which the users are solely responsible and liable. We assume no liability for any loss arising from any investment made based on the information provided in this communication. This communication, must not be reproduced or further distributed without our prior written permission. Risk warning: trading leveraged products such as forex derivatives may not be suitable for all investors as they carry a high degree of risk to your capital. Please ensure that you fully understand the risks involved, take into account your investment objectives and level of experience before trading, and if necessary, seek independent advice. So you can find the full risk disclosure on our website, along with all the legal documentations that you might need. Okay, so let's move on. That's out of our way. A quick feedback in regards to whether you can hear me loud and clear would be really, really appreciated, guys. Over here, you can see our email address, webinars@hfm.com. So contact me for anything you need. So just a quick yes would be brilliant in regards to the audio, guys. So advanced moving average. So just a bit of an intro. Thank you very much, William. A bit of an intro. Remember that moving average comes from statistics, right? So it's basically the average value. Is a series of the average values of different subsets of the full data set. So in Forex, in our charts in the market, we are getting a straight in a line. Sorry, not a straight line. In a line, we are getting a series, a sequel of the average value of our asset for a particular time frame. Okay, so it's moving average is a natural complement to any time series interpretation. A moving average can really smooth out the noise of random outliers and emphasize long-term trends. And if I just share a bit my screen, for example, let's do so we have this is, for example, just out of the just to show you what I mean, smooths out. This is our this is Aussie dollar and how it has moved since the 14th of July in this 1 hour chart. So if I try to find if I try to get the moving average of the Aussie in a 14, for the 14 period, or let's say 50, for the 50 period moving average. So you see, I get a smooth line, so it smooths out all this noise, all these ups and downs, and it gives us an average area in which the Aussie tends to move. This is what it does. If there is something that you don't understand, let me know, okay? Let me know to stop immediately. So yeah, it's a technical analysis tool for any kind of asset, either forex, either stock, either commodity, etc. Okay. Actually, it's one of the most fundamentals, just because, not the only because it's the oldest tool that there is, but it's what I just said. It smooths out the noise. It's giving us an area which the asset tends to move, an average area. So, okay. Obviously, today we're gonna get advanced, so it's not just we're not gonna just cover what is moving average and how we can use it. We're gonna take it in more depth. Oops, sorry, I skipped some slides by mistake. Okay, so some of the characteristics. So okay, why we're getting a line is because the automatically MT4 finds the average values, okay, and it connects them. That's why we're getting that line. Even if we prefer the average value for the past 20 periods, or for the past 14 periods, or for the past 200 periods, and etc. So it's up to us to change the settings. So some of the characteristics or applications of moving average, as we said, it smooths out the noise. Also, it can be used as an oscillator for identify any overbought or oversold condition. Also, so sorry. Another characteristic that it has is that it actually is the base for is the base of a channel or a band. What I mean by that, so Bollinger's is a band, right? So it gives us a range in which the price is moving. So Bollinger's, actually, the midline of Bollinger bands is a 20 period moving average. So Bollinger bands are being created by moving average and so in the mid we have, as I was saying, the 20. Let me put it on to remind you a few things. Okay? So a lot of the tools that we are having is based, its basis is moving average. So one of them is Bollinger's. So the Bollinger's use, in order for the Bollinger's to be created, they use the 20 period moving average, which is the middle line, and the upper and lower line is a standard deviation of the 20 period moving average. So that's why with the use of moving average over the years, analysts, economics, mathematicians created other tools which use as a base the moving average. Other than that, so it helps us pretty much to identify a channel, resistance, support area, trend direction, whether the asset is bullishly biased or bearishly biased, or something is changing in regards to its bias. So in many cases, and for many traders, it can be used in order to, it can be used as an entry or an exit trigger. Okay, so if we had to choose, if we had to choose one indicator as the most reliable one, that would be the one, because it's the base of everything. So just a bit of an intro. Okay, you know that the price of assets, securities, indices, commodities, forex are very volatile and sometimes unpredictable, forcing traders to look for any advantage that enables them to reduce risk and increase the likelihood of profit. So the fundamental assumption of technical analysis holds that the best approach is to check the past performance. So the past performance can inform or can help identify the future movements. So moving average are playing a key role in the determination of past price trends in order to help us identify the future ones. Okay. So okay, over here I have some formulas. Obviously, you don't need to know them. It's just for your own. Okay, I just put it on just to be aware of them. But it's just they are formulas of different kinds of moving average. So far, I'm sure that you are aware only of simple and exponential. But there are different kinds of moving average, and they are diversified into different kinds based on their calculations. So there are different calculations, and that and all of them are used to plot a line against either a price chart or another indicator. But yeah, it's just different calculation that they provide, either a smooth moving average or a different kind of it helps us take different conclusions. So we have the simple and exponential moving average. So the simple is pretty much it's based pretty much on the on summing up the values over the period and to find out the average level, or more advanced calculations such as the exponential one and many others. So have in mind that the direction, right, and the slope of a moving average line help us to identify, first of all, to identify whether there is any relationship between the past performance and the future performance or the present performance of the asset. Okay, and help us, as we said earlier, to identify whether there is any kind of divergence, overbought, oversold conditions, support, resistance, and etc. So it helps us with many things. So all these different kinds of moving average are available in our platforms in order for you to try them on and identify the one that that you believe it will. It gives you more reliable indications, and it might satisfy your strategy as well. So in regards to exponential, just to clarify a bit the difference between simple and exponential. Simple, I think we are on the same page. You know what the simple moving average is. It's pretty much the average value, nothing else, nothing more than that. So the exponential moving average is a type of a more weighted moving average. So it places a greater significance on the most recent data points of our asset. So That's why if you sometimes try to add a simple moving average and then you also add an exponential, you will see that exponential, it might be a bit closer to our price action. This is because it's a bit more sensitive. It has a greater significance. It's more a weighted moving average. So it is, how can I say that? It is more reactive to the recent price changes than a simple moving average. So it has the potential to help traders avoid missing the optimal point to open or close a position. So that doesn't necessarily mean that you need to only use exponential. You can use both, okay? You can use exponential to figure out or to identify when to enter or exit, and you can use the simple in order to monitor the direction, whether the bias is changing or not. So exponential moving averages are useful to help spot sudden shifts in price movements. That's why they've been used also from intraday traders or traders of in a very short time frame. However, they are less, because they're stone sensitive, sometimes they are less accurate than simple moving average when charting long-term trends, okay? So for long-term trends, they tend to be a bit less accurate than simple moving average. That's why the majority of the traders tends to use it in a smaller time frame. They are also, exponential moving averages are also useful at identifying levels of, as I said, support and resistance as well. So let's move on, because we have plenty to cover. I'm not sure why I put it this twice. Let's move on. Okay, so I'm not sure how many of you are using moving average and how advanced you are on this field. You know, if you have attended our live streamings or our webinars for many times over the years, actually every single day, I think I mentioned crossovers, the crossover rule of moving average. So it's not a matter of just identifying where the moving average is pointing or whether it's turning or whether the price action is above the moving average or below the moving average, etc. There are other very important stuff about moving average and how they could help you in your trading. One of them is the crossover rule. So long-term trading signals can be generated on the basis of moving average crossover rules, while short-term trading, short-term moving average going above long-term moving average that is rising is used as a buying signal, and I'm sure you are all aware of it because we presented it many times. So intraday, for example, so basically this depends on which time frame you are, but you will adjust your moving average accordingly. But just to demonstrate a bit, remember, I think I will show it many times, the strategy that Stuart is presented initially. So we said that any crossover between moving average is providing a signal. So get rid of that. So focus on the yellow and green line. So this is a setup that we have for intraday, for 30 minutes chart and 1 hour chart. So any cross, so the green one, sorry, is a 5 exponential moving average. And the yellow one is a 9 exponential moving average. So any interaction, any cross of the one above the other, it gives us a signal. So if the low time frame, so the 5, is below the 9, that's a bearish signal. If the 5 is above the 9, so let me find an example of that. Right here, 5 cross above the 9, that's a bullish signal. So the interaction, the crossover matters. Okay, that doesn't mean that you will take the 5 and 9 exponential moving average, you will apply it on all of your charts and you're in a different time frame. No, you need to test it. It seems that 5 and 9 in 1 hour, dollar yen, it looks just fine. Okay, I'm just saying that in your current setup, you might use 2 different time frames in order to identify whether the bias is changing. So in the daily chart, for example, okay, what we have, okay, it's exponential. Let me double check. Is exponential correct? So let me zoom out a bit. So okay, so this is dollar yen. This is a trend that we have seen going on forever. So the bullish cross came initially on in March last year. You see that the 50 exponential moving average crossed above the 200 exponential moving average. In the meantime, we can see that the 200 exponential moving average was providing. Let me zoom in again. Sorry. Was providing a nice resistance to the asset. Okay, the 50 exponential moving average was tighter into the price action and eventually turned above it. So that was a very prime signal that the overall bias, the overall outlook of dollar is changing. And indeed, these bullish bias lasted for more than a year. So the crossover matters, the gap, how big, how wide, wider and wider the area between the smaller moving average with the bigger moving average is getting is also a sign that the trend will continue. Okay, so over here, which we had seen it getting wider, that was a sign that okay, regardless of this correction, will continue moving higher. So that was a continuation, proof that it will continue moving up. Afterwards, however, the area over here get a bit tighter. So that was a sign of either consolidation or a bit of a slowdown, and then started getting wider again, and wider and wider, and keep supporting the asset with both pointing further to the upside. So that's just an example, guys. Okay, so we have the crossover rules. We need to be aware that the rising moving average, especially if we have more than 2, and they also they both point to the upside, is a bullish indication. If we have a declining moving average, that's a bearish indication. Crossing matters. If the small time frame is below the low time frame, is a bearish indication. If the small time frame is bouncing up of a long-term moving average, is a bullish indication. If we have flattened moving average, that's an indication of consolidation. And where is it? If I zoom in a bit, okay. Actually, let's find a different example. Maybe, okay, the 5 and 9. You see over here, so over here they clash. Right? They clash. That's not an indication of either bullish or bearish. It's more of a. Let me zoom in to see. And you see this, guys. This over here. This is a daily chart, by the way. They have clashed, and they were just. Delete points to make everything clear. They were sideways, and they were moving on the right hand side sideways, and they were they even clashed, and they had a very narrow area between them. So that's a sign of consolidation. That's something that also gives us an indication. So because if they clash, it means that there is a lack of direction. But over here, that they have bullish recourse and they started getting wider, getting away from each other, and both pointing upwards, that's an indication that there is still an increasing bullish bias. Okay, so what else? Also, I mentioned earlier they can be used as a support and resistance level. So the number of times that the moving average is being tested is important, because the more that it tests, the more the greater the significance of the moving average, because it means that the greater the support or resistance will provide. So, for example, let me see whether I would be lucky enough to identify something like that, to present you something like that. Okay, that's not great. Okay, let's. Get a little pointers over here. So, okay, what we have over here, we have 50. Let's keep it simple. Sorry. Let me add another box. So this is, let me put the 100 as well. So we have 50, we have 200. Okay, let's use 100 with a red line, yellow line. So, okay, let's see. So that seems that it is satisfying the aspect better. Why? So the 50-day one, the 50 period one, was retested and broken many times, okay? But the 100 one is providing a nice support to the dollar index 4-hour chart. You see, it was retested over here, it was retested over here, but never broken. So it's providing a nice support level to dollar index in a 4-hour chart. Over here, it was broken, but that means that now it has turned into a potential resistance area, and that the so far uptrend has run out of steam and a new downtrend started. So see how many times it was retested is an indicator on how strong support or resistance area could be. Okay, so let's move on. So I have 2 airplanes over here, right? It's just an interpretation of how it's a way to think about moving average, right? It gives you direction, it gives you strength of a trend, okay? Because the steeper it gets, the more the slope, sharper the slope, the more the strength of the trend is. Because if it's flat, we said there is no trend; it's just sideways movement. So think it like aircraft, airplanes. The rate, so just emphasize on that. So think about it as an airplane. So an aircraft, right? In an aircraft, the rate of climb, so how fast is climbing, okay? The rate of climb is an aircraft's vertical speed, okay? So it's the aircraft's vertical speed, right? So the rate of altitude change with respect to time. So we are measuring the speed. If you, don't know whether you hear, but usually the pilots are saying that we are at 10,000 feet per minute or per hour. So they are measuring the speed in a matter of the feet and time. So it's commonly expressed in meters per second otherwise. So the way to get the best rate of climb and the best angle of climb is by how can I say? So what I'm trying to say is that, and you see both these aircrafts. This one had to cover more feet, more not feet, more distance. Okay, so more. It took it an hour, for example, to reach that high, while this aircraft, it managed to reach this aircraft, so they are in the same level, but it took it less time to reach that level. So the same stands for moving average. So it's a matter of speed and it's a matter of angle. So what I'm trying to say, this aircraft had a sharper slope. This aircraft had a more, it was in a lower slope, so that's why it took him a longer time until it reached the same height. The same stands for moving average. I'm trying to correlate the aircrafts with moving average. So the sharper the slope of moving average is, it means the greater the strength of the trend. The smoother the slope is, the less the strength of the trend is. You know, if we have strong trend, that means it will last longer, right? So this is how you need to think about it. Okay, so what else? Let's move on. That's just for some info. Okay, so okay. Sorry. Okay. So, okay. So what we have over here? Over here, there is an example. So something that you need to have in mind is also the volatility, right? So remember, just to remind you that volatility is measured by taking the distance between the moving average and the price. This is one way of identifying and measuring the volatility. So from the chart, the very first chart above, okay, we have a Bollinger Band area over here. We can see that the moving average moves away from the price, indicates that there is a high volatility in the market. And as it gets closer to the prices or passes through the price, it shows low volatility in the market. Okay, so something that you can figure out also with moving average, but it would be good if it's combination with other indicators as well, is how volatile currently the asset is. So in conclusion, mean reversion. Mean reversion is a concept that is primarily used in statistics, right? It's a field of study where a variable is said to revert to its mean value over a period of time. So the same stands in our markets, in financial markets, such as Forex. So traders use the same concept, use this very concept in applying it to the price of the asset. So every time your price, so focus on that, on the top, okay? Every time your price deviates too far away from the mean price, okay, traders so if it gets far away from the mean price, we tend to see that traders can take advantage of this phenomenon and set some trades on the expectation that the price eventually will return back to the mean. It might sound simple in theory, I mean mean reversion, but traders need to have, and you need guys, you need to have adequate practice before you can really use this approach. Okay. So now I have this in the previous slides, but I'm going to explain them right now. So we mentioned simple moving average, we mentioned exponential moving average, but we didn't really touch the more complex ones. And this is what I'm going to cover right now. Okay, so we mentioned weighted moving average, we mentioned smooth moving average, and etc. So we have plenty of options in our platform. Okay, so if you have noticed when we apply moving average, this box appears. So we have the option to either use a simple moving average, an exponential moving average, a smooth moving average, or a linear weighted moving average. So these are different kinds of moving average. So each one of them it has a different calculation, right? And we already explained the difference between simple and exponential. Now I'm gonna explain the smooth one. Okay, so smooth is a combination of the simple and exponential together. Okay, so it's like a merging. So it's a combination of simple and exponential, and it superimposes all the available history related to our asset. So it's a comparison. Okay, I haven't put on the formula, but it is a comparison of the simple and exponential. So what's the benefit of it? Let me just show you. So the MT4 and let's go over here and let's keep the single moving average. Okay, just to focus on something. Over here we have 50 period exponential moving average. Okay, if we try to, I'm gonna put another one in yellow, 50 again, but this time smooth one. Okay, and I'm gonna use another one, and again 50, but simple one, just to see for you to see the difference. Oops, I didn't put it on. Moving average. Okay. Oh, I said okay, sorry, I said them twice. Just fix it. So we have one which is exponential. We need another one, a simple one with green. Oh, finally, and we need another one, yellow, but smooth. Okay, just for you to see the difference. Okay, so as I said, what the simple moving average is a merge of these two, of exponential and simple. Okay, we said exponential tends to be slightly closest to the price than the simple moving average. That's why we're getting the simple away, so higher. The exponential closer to the price, and now we have the smooth as well. Because it's a combination of these two, we can see that it ends up on the price action. So using the smooth moving average in combination with the exponential moving average together, we can actually get some interesting signals when these both lines cross. The smooth moving average tends to be the one that is closer to the price than the exponential moving average. Okay, so obviously any cross of the smooth below, like here, which is below the exponential moving average, indicates a bearish reversal. If smooth crosses above the exponential moving average, that will indicate a bullish reversal. However, in this case, it doesn't really satisfy well our 4-hour chart. Let's see. So we shouldn't use it. Let me check over here. So touch it. Okay. Oops. You can apply it, but you need to make sure that it satisfies your asset, right? So it's far away. This is a small. So okay, that looks quite interesting. It satisfies the daily dollar index. Okay, it's providing a nice support. Can you see that the yellow, the smooth exponential moving average 50, so the smooth 50-day moving average satisfies quite well the dollar index. So it was retested several times, but it provides a nice support. Why? I will get rid of the simple one just to make it a bit easier for you to understand it. And if I zoom in, we can see that they get wider, so that's a bullish signal as well, because they both point in the same direction and they keep getting wider. That means that we have a strong trend. And if I go backwards, okay, that was the very first bullish cross, suggesting that we might potentially see an uptrend. And this is what we saw actually. If I zoom out, you can see that. I go over here, we had a bearish cross over here, right? And that indeed lasted for a few more days until bottom 89 area. Again here. So you see, it can either be used again for crossing over and getting signal, but also sometimes the smooth version moving average provides a better support and resistance area for the asset. You see, in the case of dollar index, the 50 smooth moving average, it provides a better, it satisfies better the daily dollar index. You see, right support, and turn now it was broken, so indicating a downtrend, and it providing a nice resistance area. Retested, never broken, retested, never broken, until it broke over here, identifying that there is a reversal of the trend, right? Indeed, it happened, and now provides a nice support area to our dollar index. So this is what you should do it, like test it and see what works for your time frame, for your asset, and etc. Now, another one, we have a linear way moving average. And it's just a different kind of moving average. So what it is, I mean, sorry. what I wanted to say, yeah. So the linear one. The linear one, again, it's based on a different calculation, but is a moving average that reacts faster to more recent price action. So it's mainly used by in lower time frames, but depends upon the asset. So it reacts faster to the recent price reaction by putting more weight on the most recent candle's closing prices. So it takes into consideration mainly the last few candles. So it does this as the name suggests, linear weight moving average. And this linear element that it has is just a difference in the calculation of the indicator, which is too technical. You don't need to be aware of it. But have in mind that it has a faster reaction. Just keep that in mind. It has a faster reaction to the price action, and that's what makes it different from the other moving averages. It makes a great companion if it's combining with the traditional moving average, so the simple moving average, because it shows fast reactions and provides some signals to trade ahead of the time. So, okay, so let me demonstrate something. Okay, so over here, let's turn the blue one into a simple, and let's turn a smooth one into linear. Okay, you see that it came above it because it might be the one closest to the price, because it's the linear weighted, and it reacts faster. So that's why if you're gonna use it, you need to be a bit careful with it, because it's the fastest of all. So I'm gonna, so this is the daily chart. So we have seen them over here clashing, suggesting consolidation, and eventually the linear started moving above the simple one. So that was a bullish indication, and slowly, they started pointing to the upside, okay, and supporting the asset. So that came in line with our other indicators. So that's a bullish sign. Afterwards, once the asset managed to broke our linear weight moving average, that could have been your exit area in case if you have to take a long position over here. So the breakout of our moving average, the linear moving average in this case, it could be an exit point. Okay, and you see both of them started flattening a bit, suggesting consolidation. The area between them get closer, narrower, suggesting that there is a bit of a indecision over here. So down, then ups, and then again down, a bit of confusion, and eventually it started appreciating again. It's good to be combined with other indicators as well, but as you can see, the rebound away from our linear moving average and the breakout of that resistance level is what has reinforced the uptrend, with the two moving averages getting wider, getting far away from each other, confirming further upwards movement. Okay, so you don't need to use all of them, guys. It's just you're gonna test a bit, you're gonna see what satisfies your asset. Okay, you're gonna practice a bit and see, okay, yes, for dollar 1 hour chart or 5 minutes chart, I can see that what satisfies what it gives me a better indications, let's say, okay, is the No, that doesn't look good. Is there? Let me play a bit with it. Neither that, no. It has delayed signal, so over here there was already rebounds, but it was delayed. So let's see. Oh, okay. No. Let's try the smooth one. Okay, that's the simple one. Ouch. No. Oops. So you need to practice, you need to test. So let me just, so I have over here the 10 simple moving average and the 10 linear one. Bearish cross, that's fine. The bullish cross over here was a bit delay over here. Again, another bullish cross, okay. Bearish, but okay, it's not that bad, but it's not great. So you need to test it. Maybe it's the time frame that I'm using, not satisfy my time frame as well. So no. 1 hour chart and see what it has to tell us over here. Too tight. It's too tight. Let me try. Maybe the linear is not an option. This one. Oops. I have my smooth. Yes, that's correct. And let's use an exponential one. So yeah, that looks a bit better. You see that bearish cross down, then they started getting closer, so flatten and again down. Okay, that looks a bit better, even though it's very, very close to the price. So we might need to. Okay, let's see. Bam, 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 bam. Flatten, consolidation. Okay. Yeah, you need to test, and test. So let's move on. Something else that you need to consider is that you might get even more complex than that and change actually where the moving average is applied to. By default, the moving average, regardless of which moving average, either it's the smooth, either the exponential, the linear, etc., it takes into consideration the close price of each candle. But you can change that, okay? You have the option to apply it only on the open price, to apply it on the high price, on the low price, to apply it on the mid between the high and the low price, okay, or on the average of the previous candle. So to find the average between high, low, and close, and to do all the calculations based on the average of the average price of the previous candles, to be a weighted close as well, or based on an indicator. Okay, to find, let's say, let me think about it. You want to change the settings of, let me think about, so you have MACD over here and you want to apply the moving average on MACD. Sorry. And, sorry. First indicators, previously first indicators, is that one? Oops. So if you want, for any reason, let's say actually ATR, okay? We have ATR, for example, okay, right? And I want to get the average of ATR, but plotted on my chart. So what you can do is, let me get rid of, okay, is applying the moving average and and select. Okay, you see? So I'm getting the moving average based on the indicators data. Okay, so with this way, okay, I know that based on the ATR, okay, the average low that I could get is that one, 106.50. Okay, so the support for my asset will be down here based on the moving average that I have used based on the ATR values, for example. It provides like something like a midline, again, an average line. These are different things that you can try out. However, something that I consider, okay, it's getting a bit more complex if you're using a moving average for one of your indicators, from one of your indicators, it's getting a bit more complex. But what it might be, okay, over here they are the definitions of exponential, smooth, and linear weighted moving averages. Okay, just remember that the weighted is a heavier moving average. Okay, oops. The exponential is the linear reacts better on the recent price action. The smooth is more sensitive to the price action as well, and so on and so forth. Everything that we said earlier. So, so here this is a repetition of what we have already said. So, in the rest of the smooth moving average, it gives you the recent price. It gives the recent price an equal weighting to the historical ones. So for long-term average, the long-term average should be used when trading only too smooth. If price is above the smooth moving average, that considered to be a buying signal. And also you can use, you can liquidate that position when the current price crosses below either of moving average, or for a short position, you can sell when the current price is below the smooth moving average, and so on and so forth. I'm gonna keep going because I want to show you. Okay, that's the calculation of weighted moving average, but I prefer to show you a demonstration than stick it on the theory. So here we have a weighted moving average, okay, and a simple moving average. And as I show you in my platform, the weighted moving average is more sensitive and follows price move closely than its corresponding simple moving average, but they work really good together because their interaction help us figure out, help us getting some signals, crossovers, direction, continuation of the trend, etc. Can you see over here? Do you remember the aircraft example that we said? The sharper the slope is, the stronger the trend is. So you see how steep the slope of both of them are, and they keep distant to each other, pointing both to the upside. That was considered to be a really strong trend. Then crossover over here was a sign that this has over and a new trend has started. So the fact that the weighted moving average over here, can you see that? Let me draw that. Can you see over here the weighted moving average turn, posting something like a rounding bottom. So that was the very first indication that maybe the downtrend has run out of steam, maybe it's over, maybe we reach a bottom. Indeed, later on, the crossing confirmed that. Okay, so everything matters. The slope, the rebound, if they post a rounding bottom, if they or rounding top, if the one starts to move towards the other. You see that over here. Everything matters. So, this is a good combo, weighted moving average with simple moving average. The smooth moving average works better with exponential moving average. Okay, so yeah, okay, let's see another one. Okay, okay, that's again a weighted and simple one, so I'm not gonna go through it, but just a bit of an alert over here. Because weighted moving average is more sensitive to price movement, it experiences more whipsaws than a simple movement. Can you see that? That it was not only retested, but also broken several times. So in this case, the simple moving average provided a nice support to our asset. Okay, so this situation could be used either for exiting existing positions or adding to the existing position. So what I mean, if you had been long in this case, for example, this rebound, the fact that it broke the weighted moving average but managed to help above the simple moving average was an indication that the trend will continue to the upside. So that you could consider adding to your existing position. Okay, so okay. So the difference between we're using the default ones, which are the closed price ones, or using the high ones, the high levels, the high price of on our candlesticks, or the low price of our candlesticks, and etc. There's not a significant difference, but have in mind that if we are in an uptrend, okay, we're in the middle of an uptrend, and we are watching, let's say, whether our moving average is moving further to the upside or not. Then, if we amend our moving average, okay, and use instead of the close price, the low price of the candle, okay, of each candle as an input of our moving average, this makes more sense than using the close price, because it will give us, with this way, the moving average is only, with this way, we change it. Okay, have in mind that we are in an uptrend. So we are in an uptrend. So if we change our moving average to take into consideration the low price of the candle, with this way, the moving average is only breached when the price bar penetrates the average lows of other price candlesticks. So the same concept could be applied during a downtrend by changing our moving average and using and changing the moving average in order to take into consideration the highs of our candlesticks. Okay, by the way, this is not the requirement, okay? It's just an example. This could we could see that the moving average will only be breached when the price bar penetrates the average highs. Okay, so I have examples over here. So low price has been used for the blue one. Can you see that it was different than the red one? It gives some space, so we could see that this way the moving average will be hit only when the trend will actually reverse. Okay, or in a downtrend, by changing the moving average from a close price to use the high price, it provides us an even better resistance area. So if that resistance area is being hit or retested, or that will be a better, it could actually give us a signal on time that the trend is changing. Okay. Oops. What's the time? Okay, we are nearly in the end, I think. So this, guys, you don't need to use all this, obviously. We give you all the material that we can, and you will adjust it based on your strategy, on your knowledge, and etc. These are just a presentation of the tools of more advanced moving average. You might test them, and you might see that they satisfy your approach, and you might consider using them as well. Okay, so over here, what we have three exponential moving average, one with that takes into consideration the close price, the other one the high price, the other one the low price. Can they all be used together? Yes, they can. Can you see that they provide some key levels? So the breakout of all three over here could be considered as an entry point for a long-term position, for a long position, while yes, that could trigger a long position, while it also, because the blue one is the closest one to our price action, right? So any penetration on our blue one could be a chance to add more to our existing position. Okay, now a retest of the blue one, it could be the very first sign that we need to exit. Okay, so that gives us an exit area ahead of the time, right? And you see that the market closed below our moving average here for the very first time. It was here, but it wasn't late, okay, obviously, but the very first sign came over here. So that was a better exit area than this one, okay? And even if you weren't sure at this point whether you should exit at your long-term position, the fact that we have two bearish candles breaking 2 out of 3 moving averages, so this one and this one, it was a nice exit that was triggered back then. If any of you missed that, as I said, number 2 could also be considered as an exit area when price closes below all moving average, and more precisely the green one, which is taking into consideration the low level. So that was the safest way, that was the safest level to exit, because it was a full confirmation that the trend has fully reversed. and so on and so forth. So here I have more examples, okay? In this case, it was stock, it was Yahoo, to be more precise. Okay, this is a bit more messy because it has 6 different moving averages over here, exponential moving average. But yeah, that's just for you to see more examples and understand how the they could give the combination of different moving average could provide different signals and also different entry points, exit points, support resistance levels, reversal of signals, and etc. Diversification signals, etc. So yeah, so I'm not gonna go through that. Over here, we have used simple moving average along with exponential moving average, 21 exponential moving average, and another exponential moving average, but based on the high and low, the average of high and low. So this option over here was a 21-day moving average, exponential moving average, and we use this option, the median price one. Okay, so this is what that shows. Okay, so this is the let me do the same. It's a euro dollar one. Let's do the same. Let's see it live. So euro dollar. So we have applied 21 exponential and 21 at the default one. I will put it in yellow. Okay, they're very, very close to each other. Okay. Just double check something. Sorry, just a second. Okay, yes. Okay, perfect. So, and we fix it. That's the exponential one, and that's the median one. But okay, that's a little bit. Okay, so simple moving average and exponential median one. Okay, and okay, see again interaction. Bearish, both pointing down in downtrend, that ran out of steam and change again and again and so on and so forth. So, remember the simple moving average generates signals when price crosses the moving average. So you can consider it indicates a long, a bullish signal when price crosses above the moving average from below, and bearish bias when price crosses below the moving average from above. And entry or exit points could be also triggered using the crossover between the simple moving average and the exponential median simple moving average. Okay, because the median, it filters the median price field, it eliminates an unprofitable trade or any delays okay, so look at that. The yellow, okay, the yellow is the standard one, the exponential with the close price, etc. The other one, the median one, it's actually, it delays a bit the signal. So in this case, the simple moving average will provide you the signal, but the median will actually help you to identify any exit area. Okay, so guys, I think I'm done. Okay, I have more slides, but they are just examples on how examples or using the median price moving average or the weighted close moving average. So I'm gonna leave it that for you to study it. So over here is the typical price one. So high plus low plus close over 3. So it uses an even more sensitive approach. So it's pretty much the typical price indicators is the average of each day's price. So it takes the average of each day's and it plotting it into the chart. Okay, so median price and weighted close, they are quite similar. Typical pricing, however, provides a simple single line plot and actually is really good on identifying any penetrations. So traders tend to use the typical price one when they want to identify penetrations of the price action. So yeah, so here you see long, and over here we have a stop, a new long position, and a stop, or either a new short position over here, and so on and so forth. So the way it penetrates with our simple moving average is the sign whether you enter or exit or close. Enter or opening the position, and so on and so forth. Yeah, I'm gonna call it a day, guys. I have put on just advantages and disadvantages of weighted moving average. Also, whether you some examples using shift as well. So using shift, something that I didn't mention, is by using shift that helps you to that it gives you some signals ahead of the time, because it literally shifts the moving average either to the left hand side or to the right hand side. So the shift, okay, let me touch it. The shift is the least important of the single moving average setting, but displays, what you should understand is that the shift, by adding shift, it means that you displace the simple moving average in time along with the time axis. So with a positive value shift, the simple moving average will be moved to the right hand side. The negative moving average will shift it to the left hand side. So by shifting the moving average, it could be useful as a tool for looking at historical data. And if you are looking for a simple moving average for the current period with a negative shift, this is not possible, because you will need a value of for a period that has not yet occurred, right? So So the way the moving average will be shifted, it can help only with better reversal signals, nothing else than that. Okay, so over here, look at that. Okay, it's an exponential moving average. We have shifted by 10 points. So we had a new moving average shifted on the right-hand side. So over here, we had a better reversal signal, okay, that this trend line is run out of steam and is changing. So that was pretty much it, because the crossover, and afterwards the shifted one went below the price action, okay, and on the away from our normal one. So that was a better reversal. It just gives better reversal signals. Okay, that's the benefit of having a shift. And over here, something that also you can another advantage that we can get from shift is that to identify again any change ahead of the time. So you can see that the exponential moving average keep pointing upwards, but the shift one has started flatten. So that indicates that in the next few days, for example, hours, we might see some consolidation or either a bit of a slowdown, a bit of a pullback. Yeah, that's pretty much it. I'm gonna call it a day. If there are no questions, I will leave it up to here. If you have anything you want to ask, send me an email, webinars@hfm.com. There are plenty of examples in this slide, in this presentation, so there are a lot of things that you need to digest and a lot of things you need to practice before trying to change your moving averages. So please, before you try anything on your accounts, check again the examples and test it either on your demo account or either in your live account, but without taking any position, before you figure out that yes, this moving average looks okay in my chart, it's satisfied it quite well, it gives me better signals than before, and so on and so forth. You need to always confirm before you're going live and before you open any positions. So yeah, that's it. Thank you very much for attending. Have a great day ahead and see you again tomorrow. Bye-bye.